Hello, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is Peter Boockvar. He is the Chief Investment Officer with the Bleakley Financial Group. Welcome back, Peter.
Ivan, thanks for having me.
Yeah, it's an absolute pleasure having you on Wall Street Silver. So, Peter, everyone has been talking about the recent rate hikes and, of course, Jerome Powell. If the Fed keeps raising rates, what will break first, in your opinion? Real estate market, stock market, the reverse repo market? What's concerning you, Peter?
Well, the Fed maybe raises one more time, but it's not how many more hikes do they do before they break something. It's keeping rates at these levels for a longer period of time that has the potential to break things. And that is because we went through a period of, call it 15 years of extraordinarily low interest rates. So every borrower, whether it was a household or a business, took advantage of those very low interest rates. And then
Right.
all of a sudden, in 1 year, you go vertical with interest rates. So every loan that's coming due in 2023, whether that's an adjustable rate mortgage, whether that's floating rate debt that's resetting potentially monthly or quarterly for
Right.
businesses, or maybe a fixed rate loan that's coming due this year, that loan that's going to be taken on is going to be at a much higher interest rate than the loan that's coming due, assuming it's not paid off. So you mentioned commercial real estate. So let's just say 2020, I decide to build a multifamily apartment or I
Right.
buy an existing one. And well, let's just say I build one. So I take out a construction loan, takes me 2 to 3 years to build it, called three with supply constraints that we've seen. And then when the project is done, assuming I didn't lock in a fixed rate, well, I convert that construction loan to a conventional loan. But now that interest rates are much higher, that 2.75% construction loan percent is going to be a 7 to 8% loan.
Wow.
So whatever budget numbers I penciled out in 2020 make a lot less sense in 2023. I'm either having to come up with more equity, I'm going to have to raise rents more aggressively, which of course is now getting more difficult, or I'm going to have to restructure something with the bank or hand back the keys.
So, like the Fed watch tool on interest rates is predicting another 25 basis points. There's a 70 or 85% chance in March. And then after that, I think it was saying like 25, I think there's a 0% chance that they'll pause. So, what do you think they'll actually do? Do you think that's more likely, Peter?
I think maybe we got one left.
One left.
Yeah, but
Very
whether they do
interesting.
one or two, it doesn't matter. We're close to the end.
Right.
I think the people have to understand that stopping the rate hikes is not a form of easing.
Right.
And like I said, keeping rates higher for longer is a consistent form of tightening. Just in the reverse, when the Fed kept rates at zero for 7 years, in their eyes, that was a consistent form of easing.
In your opinion, are we past the point of no return in the United States, like with debt and spending that is completely out of control? Are we heading for the same fate as as the Romans?
Well, I never want to say the point of no return. This country has always found a way to kick the can or figure it out. We'll always be able to sell more debt. The problem is that it has the potential of being priced at a much higher rate. The average maturity in U.S. debt of the 30 trillion is, I think, 6 or 7 years. So we do have some time, but there are a lot of T-bills that are maturing this year that are going to get repriced higher, and then next year we're going to have a whole new set of T-bills that are going to mature and get repriced higher. And interest expense for the U.S. government will be $1 trillion at some point soon, and that does create its own problems. We know for going back 40 years, deficits didn't matter, and all the
Right.
debt we took on didn't matter. And yes, you're asking a question of, do we need to start to figure out when it actually matters?
Right.
And I do think we need to start thinking about that again, because the Fed's doing QT, foreign central banks are basically selling treasuries, banks are no longer buying treasuries to the same extent. On the other hand, we have pension funds, we have individuals that are taking advantage of attractive treasury yields. But
Right.
the dynamic certainly has changed. The inflationary story has changed. Budget deficits as a percent of GDP seem to be making higher highs, so to speak. I mean, we're about to go into this recession with the budget deficit at 5.5% of GDP, and that's before a notable slip lower in tax receipts. So, and then maybe this just gets expressed in weakness in the dollar too, and we have to pay attention to that. But I do think it's fair and important to start thinking about these things, because when you look back over the past 15 years again, where were all the excesses from all this central bank policy? And I like to say that the biggest financial in the history of financial bubbles was in sovereign bonds, in terms of dollar amounts. And negative interest rates were the epitome of a bubble, where you literally had to, every bond you owned was its own hot potato. And we had $18 trillion worth of those in December 2020. Now, luckily, we don't have any. But there's a consequence to that as central banks try to reverse what they're doing, try to shrink their balance sheets. So now it's important to start thinking about these things.
Well, what do you see more similarities for Peter? Do you see more similarities now to 2008 or now to 1929 and the collapse then?
Well, 2008 certainly not, in that you almost collapsed the banking system, which is not the case here.
Right.
29 had its own dynamic too, so I don't necessarily want to say that this is like that. And every cycle has its own sort of characteristics. So a lot will depend on, can central banks sort of unwind this party that we had without causing losing control of their bond markets. And I say losing control because, the Fed has raised short rates to 15-year highs, but the long end has been relatively contained. Yes, we're up a lot. Yes, to get a mortgage right now in the US, a 30-year fixed will cost you 6%, double where it was. But a lot of that was intentional. But its economic impact is now just being felt. And as I said, as the year progresses, I mentioned commercial real estate, but just imagine if you had a 7-year ARM when you bought your house 7 years ago, and now it's going to get repriced. Or if you are a business that had floating rate debt, it's getting repriced. It's gotten repriced every month or every quarter, however the terms are, or anybody's loan that's just coming due. So the allocating more cash flow to interest expense just sort of chips away at economic activity. And I think that's what we have to watch out for. So this may not be an event just yet. It may just be what I can call death by 1,000 cuts type economic scenario that sort of chips away at activity, because like I said, more money is then allocated to interest expense rather than hiring or expanding one's business. And when you look at, again, going back 15 years, one of the main drivers of the expansion to record high profit margins was artificially low interest expense and very muted labor costs. Well, we talked about interest expense. For those that haven't termed it out, there are big companies that have, so they're okay for now. But then we now have wage costs that are going higher. We have, even though we're plateauing when it comes to wages, wage growth is running at double the pace of the 20 years leading into COVID.
Yeah, well said.
Now that's good for the employee, but it impacts the employer's profit margins and how they look to expand their business.
Interesting. Now, Peter, the Chinese and Russians, moving on to a little bit of a different subject, the Chinese and Russians, they've made it really clear that they want an alternative to the current system. And what alternative do they have, and will it work?
Well, certainly the freezing of the assets of the Russian central bank was definitely an accelerator of what was going to be a trend anyway. I think we're sort of in the let's test drive this out and see how it goes phase. I have no reason to think that it's not going to work. I mean, if China wants to buy crude oil from Saudi Arabia, they're going to figure out a way to denominate it in renminbi. And Saudi Arabia will be more than happy to accept that. And so I do think that this trend of diversifying away from the use of the dollar to transact in a majority of your transactions, this will be a trend going forward. Now, how quickly it picks up, speed, like is this more of just an evolution rather than a revolution? It's going to be more of an evolution. It's going to take time. So we're going to have to see how it plays out. And to the question again, whether it's going to work, it'll work country to country, and whether it's going to start working regionally, we'll have to see.
Mm-hmm. And you touched on a great point there, like the Saudi Arabia moving away from the petrodollar and how that can have some serious implications for the West. What happens to our way of life, Peter? Like you said, it won't happen overnight, but let's say it happens in a span of 5 to 6 years. What happens to our way of life? Does inflation just skyrocket when the Saudis end up saying, okay, we're going to trade 85% of our oil through a gold-backed yuan, or what happens there?
I think a lot will depend on where interest rates go in that scenario, and how sort of the Fed may be left with no choice but to sort of defend the dollar by keeping interest rates elevated. I think the dollar will always be a reserve currency. I say a rather than the.
Right.
We'll have to see whether it's the, but it's going to remain a reserve currency. The US economy is still going to be a very attractive place for many foreigners to invest in, just by nature of our legal system. So, but we're entering a likely, and I've argued that a higher inflationary environment for longer,
Mm-hmm.
a higher interest rate regime for longer, and that people who think that we're just going to go back to this pre-COVID 1 to 2% inflation rate, and
2% inflation, it'll never happen again.
And once the Fed's done raising rates, they're just going to cut back to zero in a recession.
Mm-hmm.
And if they need to do QE, they'll do QE, and we'll just somehow dust off the 2021 playbook, or even taking it back to Bernanke.
Mm-hmm.
And we're not going back for a while, if at all. So we just gonna have to get used to this. And what you said will tie into this as the years progress, as reason why inflation will remain elevated, interest rates will remain elevated, and we're just going to have to acclimate to a higher rate for longer environment. And it's a good thing over time. Zero rates and negative rates was a disaster for efficiently running one's economy.
Right.
So having interest rates that are at or above the rate of inflation is a much healthier environment. But you got to recycle through a lot of debt to work through that, and that's a major, painful, time-consuming transition that we are now just embarking on.
So, Peter, let's think of some hypotheticals. Let's say do you think the Fed has a CBDC in plan, and are they going to roll that out within the next 5-10 years? If the US dollar, you said it won't be the reserve currency, but it could be a reserve currency, but let's say it does drop in value like a huge amount, do you think they'd roll out a CBDC just to cover that?
I think the one problem that will prevent a US version of it is the privacy issue.
Right.
And I think privacy is a bipartisan issue. It's the one thing that not politicians, but the average Democrat or Republican in the population both do not want the U.S. government watching everything they do. That's one, even though it's been withered away, there is some individualistic mentality that I hope still exists in the U.S.
Right.
Privacy is a part of that. So it is that thought of mine that tells me that the politicians in Washington and the Federal Reserve are going to have a really difficult time convincing us that that is a good idea.
Yeah, well,
it's much easier in China. It's going to be much more difficult in the US.
Yeah, that's right. Well, Peter, it's an absolute pleasure having you come down to Wall Street Silver. And hopefully in the next 2-3 months, we can have a recap and see what happens to the economy.
Sounds good. Thanks for having me.
Awesome. Talk to you soon.